What if you had access to a tool, a secret 7-step checklist, that one of the world's largest and most successful investors uses to predict the next great financial crisis? Ray Dalio, the billionaire founder of Bridgewater Associates, the biggest hedge fund on the planet, not only has this tool, it's flashing a warning sign right now. But the warning isn't where everyone is looking. In this video, you will discover what this indicator truly is, how it works, and why it points to a dangerous bubble hidden in plain sight. This is a financial education channel. Analysis is based on the public frameworks and writings of Bridgewater Associates and Ray Dalio. Educational content only, not investment advice. To understand what's happening today, we first need to understand how Ray Dalio thinks. He's not a typical investor. He sees himself more as a doctor of the economy. While most analysts look at the day-to-day symptoms, the fever of inflation, the headache of interest rates, Dalio has dedicated his life to studying the complete anatomy of crisis. He built Bridgewater, managing over $120 billion, on a philosophy not of predicting the future, but of understanding the timeless and universal mechanics of how the economic machine works. And right now, that machine is showing signs of stress. He has analyzed bubbles and collapses spanning 500 years of history. And after all that, he came to a powerful conclusion. Crises are not accidents. They have a DNA, a repeating pattern. Because of this, many on the market search for Dalio's one indicator, a magic line on a chart that screams sell. Perhaps the inverted yield curve? The VIX, known as the fear index? The truth is, Dalio's tool is far more sophisticated. It's not a single line. It's a full diagnostic, a checklist of 7 vital signs that he calls the bubble gauge. And it's by running today's market through this very checklist that the real danger is revealed. So what are the 7 warning signs that Dalio looks for? Think of these 7 points as a complete medical checkup for the financial market. Let's go through the first 4. Vital sign number 1, prices versus history. How expensive are assets today compared to the past? Dalio looks at classic metrics like the price-to-earnings ratio. It's like taking the market's blood pressure. If it's far above the historical norm, it's a sign of hypertension. Vital sign number 2, unsustainable conditions. Is the market overly optimistic, pricing in a rate of earnings growth that simply isn't realistic in the long run? It's like a patient who swears they'll run a marathon every single day, forever. It's an unsustainable promise. Vital sign number 3, the influx of new buyers. This is where it gets interesting. How many people who have never invested before are now entering the market? Think of it like a party. At the beginning, only the closest friends are there. But when the party gets so good that even your uncle who only talks about fishing shows up to dance, it's a sign that Euphoria has peaked. Dalio saw this in 1929, in 2000 with the dot-com bubble, and in 2021 with the meme stocks. Remember the frenzy around GameStop and AMC? That was a textbook example of this vital sign flashing red. An army of new, highly emotional retail investors piling into the market, coordinated on social media, creating unprecedented volatility. That's the kind of euphoria Dalio watches for. Vital sign number 4, broadly bullish sentiment. When absolutely everyone from the media to analysts and retail investors believes that prices can only go up, the risk is at its maximum. If there are no skeptics left to sell, who is going to buy when you decide to get out? It's blind optimism, one of the most classic signs of a bubble. Those are the first 4 signs. But the next 3 are what measure the fuel of the bubble, the thing that makes it truly explosive. Let's get to the final and most potent vital signs on the bubble gauge. Vital sign number 5, high leverage. Are investors borrowing money to buy stocks? Leverage is an amplifier. It multiplies your gains, but it also multiplies your losses. When the market is filled with purchases made on debt, any small dip can force mass selling, creating a catastrophic domino effect. This was the heart of the 2008 crisis. Back then, this leverage was everywhere, especially in the housing market, creating a systemic time bomb. While today's situation isn't a direct repeat, Dalio watches for pockets of high leverage, as any concentrated debt can trigger a wider contagion if that specific bet goes wrong. Vital sign number 6, extended forward purchases. Are companies spending fortunes on new factories, massive inventories, and aggressive expansions, expecting demand to grow forever? This kind of long-term investment, when based on excessive optimism, leaves companies extremely vulnerable if growth slows down. And finally, vital sign number 7, the strength of the architecture. This is the most technical, but perhaps the most important. How strong is the system to take a punch? Are the bank's balance sheets healthy? Does the central bank have room to cut interest rates and inject money if panic sets in? If the system's architecture is fragile, a small problem can become a systemic crisis. Think of it as the financial system's immune system. After 2008, regulators forced banks to become more resilient, but new risks always emerge. Okay, that is Dr. Dalio's complete checklist, the 7 vital signs to diagnose a bubble. Now, for the trillion-dollar question. What is the diagnosis for today's market? What does the bubble gauge tell us now? And this is where Dalio's analysis becomes both brilliant and counterintuitive. If we apply the bubble gauge to the U.S. stock market as a whole, the S&P 500 index, for example, Dalio is clear. In his own words, from February 2024, when we look at the aggregate stock market, we don't see it as very bubbly. The overall percentile is at a moderate level. There isn't runaway euphoria in every sector. The leverage isn't like it was in 2008. But, he continues, when we look under the surface, we can see that there is a bubble brewing. Where? In a small, specific group of stocks that have become the center of the financial universe. The tech giants, known as the Magnificent Seven. Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. For this group, several of the vital signs are flashing bright red. Prices versus history, sign number 1, are at stratospheric levels. Valuations are stretched to extremes, with some forward P/E ratios demanding decades of flawless execution. The combined market cap of these few companies now outweighs the entire economies of major developed nations like Japan, Germany, and the UK combined. This level of concentration is historically rare and dangerous. The market is pricing in unsustainable growth, sign number 2, and the bullish sentiment, sign number 4, is nearly unanimous. The artificial intelligence narrative has created a euphoria that accepts no questions. This creates one of the most dangerous situations possible. The apparent health of the overall market is being propped up by a small number of companies that are, according to Dalio's framework, in bubble territory. It's like a patient whose body looks healthy, but their heart is under extreme stress. What happens when the heart of the market stops beating? For Ray Dalio, a crisis in these tech stocks wouldn't just be about investors losing money. It would be a catalyst for something much bigger. This connects to his main thesis, the changing world order, or the big cycle. Dalio argues that empires rise and fall in predictable cycles, and the United States is in a dangerous phase of this cycle, where 3 massive forces are colliding. The debt cycle. The U.S. government has a level of debt historically seen only in wartime. The internal conflict cycle. Political polarization and social inequality are at their highest point in decades. The external conflict cycle. The rise of China as a rival power challenges the world order. Now, imagine what happens if the Magnificent Seven bubble bursts. Millions of people lose a significant portion of their wealth. Trust in the system plummets. Anger and frustration rise. This isn't just about numbers on a screen. A sharp loss of wealth, especially when it's concentrated in popular stocks owned by millions, erodes public trust and fuels the narrative that the system is rigged. This anger can easily spill over into the political arena, creating a feedback loop of instability. A stock market crash could be the trigger that could amplify the social and political pressures that Dalio has been monitoring. At the exact moment the country needs to be united to handle its debt and geopolitical challenges. Dalio's warning isn't just about a market correction. It's about the fragility of the financial architecture. So, what have we learned today? Ray Dalio's one indicator is not a magic line, but a robust 7-point diagnostic. And that diagnostic shows that while the overall market isn't in a classic bubble, its heart, the tech giants, is showing clear signs of unsustainable euphoria. The risk isn't spread out everywhere, like in 2008. It's concentrated. And a crisis in this core could have consequences that go far beyond Wall Street, accelerating the social and political tensions that Dalio has been warning about for years. If this deep dive analysis helped you better understand the hidden risks and dynamics of the economy, consider subscribing to the channel and turning on notifications. Our mission is to bring clarity and facts to the most important debates in finance. Dalio's focus is on this concentrated tech bubble and its connection to the great cycles of debt and power. But while Dalio looks at the systemic risk, another legendary billionaire, Warren Buffett, is looking at the same bubble with a different lens. He has issued a warning about what he calls the $7 trillion artificial intelligence bubble. And in our next video, we're going to reveal why he's concerned, and what the one and only AI stock is that he quietly decided to buy amid all this risk. You won't want to miss it.